Conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you, and over to you, ma'am.
Thank you, Malika. Good morning, everyone, and I would like to welcome you to the Q4FY21 earnings call of Thermax Limited. We have the management today being represented by Mr. Ashish Bhandari, Managing Director and CEO, and Mr. Rajendran Arunachalam, Group CFO. I'll now like to hand over the call to Mr. Bhandari for his initial remarks, post which we can open up the floor for Q&A. Thank you very much, and over to you, sir.
Thank you very much, Bhumika, and a very good morning to everyone that's on the call. I hope you can hear me clearly. I'm on a handset, but I'm told the line quality is quite good. It's a pleasure to host all of you, and I hope each one of you is safe and your loved ones are safe as well. We have shared the management presentation in advance, so I hope you would have all had an opportunity to go through this. My plan is to just hit a few highlights and then open up the line, spend most of the time on Q&A, as has been the norm for previous calls as well. I think I'll maybe first talk a little bit about just COVID, what it means, and in no discussion on COVID for businesses can be had without talking about the personal impact that the second wave has had on so many families, across Thermax, across our vendor base, for many of our customers. May was exceptionally difficult, and in many ways I'm extremely proud of how the team has continued to soldier through, and all our plants were operational even though at reduced capacities when people were going through so much at the personal front. Just as an example, as you know, most of the oxygen kind of ran out in the second week of May, and when the government said, look, we need the oxygen, we turned over even the half-empty bottles that we had at all our plants back to the local authorities. And then we found other ways to continue to weld, ways to continue to do plate cutting. We moved to plasma cutters, we moved to natural gas based and different set of electrodes, all those kinds of things. And the team did that almost overnight. Like yesterday we were working with a different methodology. The next day we knew what we were working on that previously wasn't available, so we had to invent, test out, find a new way to work, did all that. Then immediately came the requirement that everyone that works at the plant has to be tested, but there were not enough test kits available. So how do you stagger? How do you isolate people? How do you figure out who's in contact with whom? Figuring out micro-zoning. Our lunch plans went from 1 slot to 5 slots, and so that you could make sure that people could be isolated, and you had to know at each point who was where, so that you could always do contact tracing and help. We also worked a lot to make sure that migrant labor, which was badly affected in the first wave, we made sure that we proactively took care of them. So making sure that food packets were available. We created accommodation in places where accommodation wasn't available close to the factory, in one factory, within the factory as well. In other cases, we encouraged through training that vaccines are important, that running away will make it worse. So a lot of work went in behind the scenes by so many people that makes me exceptionally proud of what the team delivered in these last few months. I think you will also see some of the things that are easier to talk about, the vaccination camps. And the good thing is we finally see vaccines being made available to industry. So over the next 1 to 3 weeks, we do hope to vaccinate a good chunk of our population with one vaccine at least. So we will be conducting vaccination camps across the country, getting at least one vaccine dose available to majority of our India population. In terms of our numbers, I think they're all there for you to see, and I'm sure there'll be questions about it. In terms of order book, you can see there was more of a recovery from cement and steel in this, and refining and petrochemical, this particular quarter. But if I look at our overall order book, it is very well spread across multiple segments. And Q4 was also well spread, but some of the segments like cement and steel in particular that were weaker in Q2 and portions of Q3, while many of the other segments, pharma in particular, that was strong at that particular time. You can see our order book is truly broad-based, which is a good thing for the business overall. I think increasing trust on sustainability, I think in our large boilers business, 2 quarters in a row, 100% of our orders have been in what we consider to be green projects, which means they're waste heat recovery, biomass, blast furnace gas recovery. So all spent wash, all applications that are either renewable or are taking waste into and converting it into something of use, which was interesting, I would say. The second thing I would say is that you will see that even in this quarter, we did not have a single order that we had to report to the street as an exceptional item. Yeah, so we delivered close to 1,500 crores in orders without anything that was even 200 crores. Yeah, so there was good single orders, but many of them across the company that has really helped us deliver a decent quarter without a single bluebird of any sort, which I thought was particularly good. Also, symptomatic of the broad-based recovery statement that I made previously. Some of the business-specific highlights are all captured out there, and I think as is some of the moves we have made on the technology side, I think I will be happy to answer any questions. Most of these are too early because they're all relatively new products or innovations that will take some time before they start to show up on the ground. But it's important for us as a company to start moving in terms of new energy in a much bigger way. So these are just some small steps in that direction. I think beyond that, all the indicators, all the segment performance, everything is out there for you to see. I know there'll be a lot of questions around trends and how is commodity pricing being affecting the business, etc. All that I think we can answer as part of the Q&A itself. Happy to, Rajendran, would you have anything to add?
Not specific, Ashish. I think you covered all the business aspects of it. Only from a financial performance front, I think we continue to maintain reasonably good margins for Q4, and our working capital performance has improved. I think that is clearly reflected in our numbers that we have put out. The cash surplus consequent to the working capital improvement is also at an improved level compared to last year. Thank you.
Thank you, Rajendran. So look, with that, we can open it up to questions and use that as to share more information.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1 now. The first question is from the line of Bhalchandra Shinde from Max Life Insurance. Please go ahead.
Good morning, sir. Sir, regarding order book, overall our order book has stayed flattish right now. And in this quarter, I think there will be a constraint on fabrication side also because of the supply of oxygen. So do we see executing these orders? Means, what kind of a sales growth we expect in FY22?
I think you've asked three questions. Let me first talk about FY22 overall, and then I'll come to the short term. I think FY22 from a sales number perspective will depend quite a bit on our ability to deliver, and our ability to deliver will be limited primarily by COVID and future waves. Yeah, I think just like we saw last year, that as the country opened up, and in Q4 in particular, but Q3 and Q4, we could increase the capacity utilization and pump out quite a bit. Even in those months and quarters, I don't think we reached the complete potential of what we can deliver. Yeah? So I think overall capacity and capability exists to deliver a lot more, and in places like chemicals where we were capacity constrained, we have increased capacity as you know, and that capacity is coming online. So I think if I definitely see Q1 as being challenged because of all the reasons that we talked about, and not because that demand is not there. It is being driven entirely by our ability to supply. Yeah, and but if we get good 5-6 months, we should be able to recover what we have lost in these few weeks of Q1, where productivity was lower than what we would have liked it. So that is to the sales number. Overall, though, I still don't know how demand will also come back. Yeah, so demand after the first wave came back reasonably strongly. We finished Q4 where we thought every metric was trending above what it was before wave 1. Yeah, so that made us reasonably positive on our outlook. Now where we see some of the bigger projects coming up for decision making, because we haven't really, if you take a look at the last 6 months, we have had no big projects come up for decision. There are projects in oil and gas, in FGDs, even in chemicals, which are now somewhat coming to the discussion table, which gives us confidence that over the next 1 to 2 quarters, we will see some bigger projects getting decided. But along with that, we would really like to see the kind of recovery that we have had in Q3 and Q4 of last year, which was this broad-based recovery, continue. All of this is a hope. I don't think you can build a company and drive the company on hope. So we are focusing primarily on flexibility, nimbleness, making sure that we have good visibility into the short order, and manage the company thereabouts. Yeah? So I don't see any major red flags, but it's too early or too difficult to commit to what all of 22 will look like.
Sure. And second question regarding, sir, commodity prices have been spiked up in the last 2 quarters. And there might be some fixed contracts within our order book. How much it will be, and what kind of impact we can see over next 2-3 quarters?
So I think we saw commodity pricing in Q4. We had quite a bit of an impact driven by commodity prices, where I think upwards of 10 crores was our impact based entirely on commodity pricing, mix of steel, aluminum, but also in the chemicals business of styrene prices going up. Even in Q1, we will have an impact of this. I think we wouldn't want to share a number, but definitely there will be an impact. And the reason I don't want to share a number, because we don't know what the overall number for Q1 will look like. And it's not that we don't have plans. We have multiple plans, but the scenarios still have variance. Yeah, if June is completely clean and there is good productivity, then we have one number. If June is completely challenged, then we have a different number. And I think the truth may be somewhere in between. So it's tough to say what it will look like. But commodity pricing has an impact. The way we run our business is that when we get an order, within the first 30 days, we basically retire the majority of the commodity risk. So our commodity risk is typically open from the time frame of when we receive an order, from where we send a quote to a customer, a final quote, to the point that we receive an order. So I would say for our large businesses, we have an open impact of about 2 to 3 months. Yeah, because that is the period where, for a government project, as an example, we would have submitted a quote, but we don't get the order until a little later. In all other cases, we go back and increase our prices, we go back and renegotiate, we manage with our customers, and our prices in the market are also going up as they have to in the current environment. Some of it you can absorb through productivity, improved utilization, digital, a lot of other good habits we have cultivated through COVID. But some of it has to be passed on to customers, as a price increase.
Sure. Thanks. I'll come back for further questions.
Please. Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life Insurance. Please go ahead.
Hi, sir. Good morning, and thanks for your time. A couple of questions. One on the order inflows again, and very, very good number actually in the quarter, given the lack of any big sized orders, and you still did about 1,500 odd crores. So just trying to understand, of course, leave apart Q1, but with the assumption that Q2 onwards we see a normalization, do you think you can sustain this 15 billion kind of a quarterly run rate? Maybe starting Q2, Q3 onwards. And more importantly, you did talk about some big projects in oil and gas, FGDs. If you could also talk about any specific projects here, also other sectors like cement, steel, so if you could talk about these core and large sectors as well, how do you see ordering over the course of the year?
So let me first answer your first question. And the answer there would be, I think, difficult to say. And difficult to say because I think, and I'm saying I think a lot because as a team, we talk about this a lot and we read a lot. And the more we read, the more we realize that we don't know everything that is possible. And specifically, I'll talk about the broad-based demand that we have had. Yeah, in Q3 and Q4, we kept talking about, look, in Q3, for example, that while we have had a recovery, good portion of it may have been pent-up demand. But then that pent-up demand continued in Q4, which was good to see because Q4, we started the quarter, we were hoping that some of the bigger projects will come through for finalization, and they did not. Meanwhile, some of the rest of it continued to be stronger than what we expected. And then steel and cement started to add capacity. So we had some 80-100 crore projects, multiple of them starting to show up, which was good to see. Now what we are seeing is that COVID, as it's taking us through the country, we have seen our demand from our distributors come down. Yeah, which is the worrying part. Because after the first wave, the best part was that the recovery was broad-based, and especially in Tier 2, Tier 3 markets, we got great demand from food, from agriculture-based companies, from textiles, variety of other segments. Right now, we see they slow down out there. Yeah, May was halfway decent, but by the end of May and June and July, we expect a slowdown based on the pipeline and the opportunity set that we are working on. What we cannot say is that whether that is the impact of COVID reaching rural areas, and once COVID passes through, just like it has gone through the big cities, whether that demand will come back or not. Yeah, so I think if that demand comes back and it is strong, then of course we can do those 1,500 crores in the future as well. But I don't think I have that confidence to commit to anything like that. Yeah, meanwhile, we do see some of the bigger projects coming up for finalization, and FGDs, for example, which was completely zero, is now finally starting to have some minimal activity starting to happen. And we do think between Q2 and Q3, we will have 3 or 4 major finalizations. We will also see whether we win those or not, we can't say, but we at least start to see those being finalized. Similarly, in oil and gas and refining, all the government companies that were slow because of COVID, they're all kind of taking the projects that they had put on hold because of lack of people availability. All of those have started moving again as well.
Okay, fair. Very helpful, sir. So secondly, on the energy business margins, right? I mean, again, for the second quarter, close to about 9% EBIT margins is what we've seen. Again, leave apart Q1, but if you had to look at it over a year or maybe the next 2 years, what's the kind of margins that you are looking at in this business at the EBIT level?
Look, I think we understand the margins had come down in energy. Part of it, I think, has also been the additional depreciation that we have had to accommodate for the one plant that we acquired in the recent past. So I think there is nothing more to be said other than that we are focused on improving the margins at our plant and overall in the energy business. That margin is dependent not only on us, it is also dependent on commodity pricing and competitor reaction in the commodity pricing. Yeah, both of these two factors are not entirely in our control, but in terms of cost management, making tough decisions, cutting down our losses, all of that we will continue to do. Yeah, and even in the last year, you saw we executed VRS. We have taken hits on a couple of our international businesses where we thought a hit was merited. We have also used that as an opportunity to cut costs in some cases. I think all of that is good, but we have this headwind of commodity price increase, which I think is something that we are all battling through. So I'm sure you're looking for a clear answer. I don't have a clear answer to give you, but I have to talk to you about the metrics that we are looking at and managing. Rajendran, would you want to add something?
No, I would only not much, but I would just like to add that this year we've also had a good amount of expense control, and with our factories working to full capacity in Q4, the output has been good. The expense control has also been helpful during this COVID time, and I think that's both of these are also definitely helpful improving our margins. Thanks.
Fair. Good to know, sir. And just one last one, if I may. On the refining capex and slightly longer term over the next 4-5 years, what we understand is, HPCL talking of no more new refineries post Rajasthan, BP again, with the divestment and new owners, not too much of refining capex there. I think IOC probably is doing about 3-4 locations, but that's, I'm hoping, pretty much it, right? So from a slightly longer term, 4-5-6 year perspective, do you think refining capex as well maybe on a decline and maybe something which may go the coal-fired plant way, where you may not see too much of refining capex or new capacities coming up?
I think in general I would agree with you. I do think refining, at least if somebody would have asked the question 3 years ago, we would have said there would be India's kind of oil needs will grow 8-9%. We will continue to need a new refinery every couple of years, I don't think I would be as bullish today. Yeah. So refining for diesel, for gasoline, for jet fuel, I think demand will continue to grow. I do think there are a couple of more projects that are planned, but it will not be to the extent that it was before. Yeah, and I certainly don't see some of the biggest names in India going forward with projects that previously, even a year and a half ago, they would have said they will go forward with. But that by itself does not worry me entirely, because I think as a world, we all have to be clear that the energy footprint and the carbon footprint and the energy efficiency, both of these are something that is very important for our planet, and so things have to change. The question now is, how will things change? Yeah, which means if India now has to replace that demand for all of those fuels with something, and that something, if it is hydrogen, then that whole hydrogen economy creates a whole different set of new projects. Yeah, because you'll still need chemicals, you will still need end products, you will still need everything that you need. You still need tires, you still need pharmaceuticals, you still need petrochemicals. So all of that has to come from something. So whatever that something is, has to be something that Thermax can align well with. Ultimately, in all of those processes, and I would say with some amount of risk, yeah, because there is technology being looked at where the entire process itself changes. But in most of the other ways, the look is in terms of what will that refining get replaced with. Yeah, so it will. You still need heat, you still need steam, and what Thermax has to do has to be ready for whatever that new world looks like. So I think in general, I will agree with you. And I think a 6-7 year time frame is a better time frame to take, because the next 3 years could still be surprising, could be decently bullish, not just for India. There are some new projects even outside of India that are being planned. I think they will go ahead. But if you take a 5 to 10 year period, I do think many of these segments and industries will change forever. I would agree with that.
Yeah, great. Thank you so much. Very first of all.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Thank you so much for taking my question. Just on one of the projects which is mentioned in your presentation about a green steel supply taken on a build on operate model. Just one clarification I need. Have you taken this asset on our balance sheet?
Could you, if you would, I think so your question is of the build own operate project and whether the project has been taken on Thermax's balance sheet. Yeah, so it is taken on the balance sheet of a wholly owned subsidiary, TOSL, which is Thermax On-Site Services Limited. And yes, it is, in fact, last year, Build Own Operate was one of our fastest growing areas, where we have executed our highest ever order book and all of these projects are long term, on average 10 years contracts, where we commit to the customer to provide utility as a service. Whether it be steam, whether it be water, whether it be both power and steam in cases, that's the project. And it's on Thermax's books overall through our wholly owned subsidiary.
Yes, thank you. So just one.
If you can speak a little louder.
Sure. I'm audible now?
Slightly better, yes.
Yeah. So basically the question, just carrying on the momentum what you talked about on the orders. So if one has to look, the broad-based recovery, the term which you used, if I look at your cement, your refinery and metal is still about 50% of that backlog, and assuming the rest of the sectors are any which ways makes cash flow, which generally comes as a recurring base orders every year. In the 3 segments, which is cement, metal and refining, where do you see, more growth coming in? Because This question I've been asked to the earlier, management as well. So cement has tripled its capacity, whereas our order intake has been in last 8 years has been at the similar range. So obviously some sectors goes down, some goes up. So generally, in your view, is it when you talk about the large project, if you leave aside the cement, any other sector you think which can grow much faster here and where you expect better recovery? Because I'm asking you because you used a word called broad-based. And when you say broad-based, then I thought there would be, we will, as a Thermax, will be trying to grow more than what we have grown in last 8-10 years, a 6,000 crore order intake company eventually. So if you can throw some light on that, what's your plan there? That would be helpful.
Sorry to interrupt, Mr. Arora. So this disturbance is coming from your line. I request you to mute your line while the management answers your question.
Sure.
Thank you. I would say if you take a look at Q4, you're right that cement, steel, and refining are particularly strong, but that wasn't the case in Q2 and Q3. Yeah, Q1 was practically nothing. So I would say that if I look at our backlog, it is less driven by big projects, less driven by one-offs than it has been in the past, which is, I think, something that is clearly borne out by data. It's not a conjecture in that sense. As I look forward to, I will say that there is uncertainty. Yeah, I would like nothing more than the broad-based recovery that we have seen previously in India to continue to hold. Yeah, but we don't know whether that will happen or not. The other thing I will say is that you take a look at even cement. Cement is, as an industry also, has changed quite a bit in India. Whereas previously, if people would have put up a cement plant, most of them would have put a captive power plant, which would be coal-based, which will have its own boiler and auxiliary boiler and everything else, and the paraphernalia that goes with it. That's not the case anymore. Yeah, majority of the projects that we have had are waste heat recovery projects, which is to improve the efficiency of existing cement plants. Also, where people are looking to add capacity, they are not looking to add capacity the way they used to in the past, because the entire power plant is changing. In many cases, people are shifting to the grid, and even if the grid power is slightly more expensive, in a way to reduce their carbon footprint or whatever the case may be, they are looking at alternate ways to manage things. Yeah, so I would say, A, the nature of the industry themselves is changing. B, the kinds of projects we are getting is also changing. By the way, that does not worry me entirely, yeah, because when things get more difficult, which means you have to provide higher efficiency, where you have to do a complex application, many a times Thermax really stands out because we have more capability to do difficult applications based on our history and just the nature of the company than many others. So that by itself does not worry us. Yeah, most times if there is multi-fuel complex requirement, you need to manage a very complex set of inputs and outputs. Typically, Thermax has more of an ability to stand out. So I think that's how I would answer the question, and I think to know what the future will look like and whether the recovery will be as strong as it was after first wave, I think all of you would, based on your connect in the industry, based on everything you will have, you will probably have a better look and a better idea than I would. Honestly, I would say that.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for good numbers in a difficult period. My first question is just a clarification. The page 6 of the presentation, order book breakup by end user, is that the breakup of order received or the order book which is at the end of the period?
Yeah, if I might answer that, that's for the order book, that is the order received.
Okay. Would it be possible to share the a similar breakup of the outstanding? As you highlighted, there is a wide variation quarter-over-quarter.
The breakup of the order balance, I think that will be a large exercise for us. We will see, I think, whether we are able to make that disclosure.
Sure, no problem. The second question is continuing in the previous participant's question. As you highlighted, waste heat is a big opportunity for both steel and cement. Would it be possible to share what is the current level of penetration in the existing plants that you would have done an exercise, and what is the opportunity that you see for waste heat in both steel and cement?
I would say we have those numbers internally, and some of that is competitive information, so we would not want to share the exact numbers. The cement waste heat recovery overall in India is getting closer and closer to full penetration. Yeah, the new plants that are coming up will all need cement waste heat recovery for sure. Steel, there is still some way to go, but in cement, I think most of the major plants now have in their existing plants have waste heat recovery. I would say while India has good penetration in waste heat recovery, that's not the case throughout the world, especially in Southeast Asia and Africa. There are many plants which don't have waste heat recovery, and so it's not like just because the India cycle goes away, there is the application does not have room to run in other places. We do think as the focus on the environment and focus on efficiency increases, this is an application which will be demanded by more and more customers internationally as well.
And about steel?
Steel has some way to go, but steel also depends because you have a lot of smaller plants where the size of waste heat recovery is not to the extent that you would see in a chemical plant where the application is relatively more standard. Yeah, and so I think steel has some more room to go, both in India and outside. But it depends whether the plants themselves will go forward and execute those projects or not.
The other question is the margins front. We saw a dip in the margins sequentially quarter on quarter versus Q3 in the chemical segment. What should be the sustainable level of margins that we could expect in the chemical segment?
I think when the margins were very high and most of the analysts were asking us, can we sustain 25% and beyond and all that, we had said even then that in some ways, overall the margins in this segment are still higher than what our historical mean has been. Yeah, and this is in an environment where styrene prices have gone up quite significantly. So some of the investments and capabilities that we had done on the specialty chemical side, which overall give us slightly higher than traditional margins, you would have seen even during Q4, which was a tough quarter from a commodity price perspective. Not just that, Q4 also we had logistical challenges where we could not ship containers, etc. on the chemical side. Yeah, so when margins were very high, we were already telling that look, we don't know if that is sustainable because in Q1, Q2, the styrene prices were at historical lows. Now they are closer to all-time highs. So I don't know what the future looks like again. If it goes higher, then our margins will come down slightly even more. Some of it we will pass on to our customers. Some in cases where we have long-term contracts, it may be tougher to do because you're also in a competitive world where you are also dependent on how your competitors react, and it's important to keep the plants operational as well. So again, kind of I'm giving you an answer where I'm hedging my bets. I would say where you are right now, we would like to be able to sustain those levels for sure.
Thanks. And the continuing question on the...
Lani, sir, I would request you to rejoin the queue for follow-up questions.
Thank you.
Thank you. The next question is from the line of Jonas Bhutta from Phillip Capital. Please go ahead.
Hi, sir, and congratulations on a great set of numbers. Two questions, sort of longish. Sir, just wanted to understand on the energy segment side, sir, given that, bulk of your order inflows this quarter have been sort of less than 100 crore order value average. Wanted to understand, what portion of our revenues or order book currently or order inflows come from the standard products business. And this question is particularly to the energy segment. And what was it about 3 years back, and have you seen some marked improvement because on lack of large orders being there in the market? And whether you expect that over the next 2 to 3 years, this sort of proportion of sales from the standard products continues in light of, what you just mentioned, where you expect orders to pick up from oil and gas, GD, maybe even food, pharma, and what we are seeing on ethanol blending and stuff like that. So the long short of it is, what should we see as standard products as a percentage of sales for energy over the next few years? That's the first question.
Okay. I think, and thank you. Yeah, I think it's a very good question. One we talk about, and it's an area of focus for us as well. And the way I would answer your question without giving specifics is that we are roughly 50-50 between projects and what we call as products and services. And things like chemicals we put as part of the second bucket. All of our large boilers business and everything that we do in EPC comes as part of the first bucket, which is the project. So we are give or take 50-50. Overall, in the last 3 years, if you take the project business is very cyclical. Yes, any answers I give you is averaging out that cyclicity. Typically, our services portion, which we put as part of products and services, has grown faster. Our products have not grown as much as we would like it to be. Yeah, as we look forward, what we do not really look at how products do relative to projects because it's very difficult to look at that number, because you may think you are doing well, and then a single big project order may skew your number entirely. Yeah, so I don't think that's the right way to look at it. What we are looking at is, and monitoring ourselves very carefully on, is sequential growth in both products and services, which means we would like more and more of our products and services to continuously grow irrespective of the economic environment. And projects, we have the capability. When it comes, it comes. But otherwise, we continue to focus and make sure that our products and services, we continue to build on it and grow. So that's a better way to look at it. Have we delivered that continuously in the past? Maybe not as much as we would like. Is that a big area of focus for us? Definitely. Do we see we are working on that and that improvement is showing? I think the broad-based recovery is some sign, but I don't think we can rest at all here. We have a long way to go out here, and the recovery shouldn't lull us into any point of confidence at all. Yeah, and also, as we keep saying, the world of the future will be driven by data, will be driven by services. So we need to be able to do a lot more in many of those areas going forward. I think at this particular point, this is as much as we would be able to share. And we will not give a breakdown of how much is services specifically within products and services. Sufficient to say that that is a portion that we want to grow the fastest.
Sure, so that's helpful. My second question is on the new initiatives that you highlighted in the presentation. While you clearly said that these are very nascent at this point in time, but just wanted to pick your brain on 3 of these things. Firstly, the tie-up with SB. we always believe that sort of Thermax shies away from any direct business with municipal local bodies. So while, at the outset, this business looks focused towards that end market, can you just elaborate on what is the mode of business that you've thought about? How are you going to approach that market, or is there a change in strategy about dealing with municipalities? That's the first one. The second one, sir, on the hydrogen bit, which is where we've developed that 5 kilowatt fuel cell for CSIR, and also we worked with DRDO. Just wanted to understand in commerce, when you have to commercialize this to say megawatt sized units, what are the key milestones or challenges that you think we'll have to watch out for, and the timeline therein to sort of get to this level of having a product ready to offer to the market and then waiting for the market to sort of pick up. This is a gray area for us right now because don't really know what's happening on hydrogen, while globally there's a lot of noise. So on these two things, if you can highlight your view, and the solar film business again, the applicability in the Indian context.
So you had one question, 3 questions, so I'll try and answer all of them. First, in terms of the municipal business, there is no change here. It's not that we don't work for government. So much of our business is some ways, one way or another, depend on companies that are owned by the central government, and even in cases state government. But directly dealing with municipalities is something we have stayed away from. And even in waste to energy, the idea is not to deal with the municipality. There will be a project developer for whom we would be executing the project. We do expect that this would be a true localization, which means the partnership will help us. So far, so many of the waste to energy projects in India, unfortunately, have been done by through Chinese technology. And which I think from an Atmanirbhar perspective, from so many other ways also, is something that the country needs to change. So we do expect that through this initiative, we would be spending quite a bit of our effort on localization. And I would say the whole waste to energy market itself in India is also nascent. Yeah, because the policy also has to change. The current pricing that the government provides to developers is not sufficient to make these projects viable. And because the entire social cost of these projects is not accounted for correctly. Yeah, very clearly the power that comes from these projects has to be higher, because the power not only cannot compete with a coal-based project, but the idea of this trash really hurting the environment, hurting people, making our groundwater worse. The social cost of all of that is multifold of the cost that the price that the industry is demanding for this segment to be successful. I do think that will happen, but it does depend on our policy keeping in touch with what is happening the world over. But we expect to work with developers, not directly with the municipalities. We don't plan to be a developer ourselves. So that's the first question that you had. To the second question on fuel cells, not just fuel cells. Yeah, look, right now India, as it looks at hydrogen, we have about 15 new technologies that India will have to look at. Yeah, everything from solar to batteries to fuel cells to methanol reformers to coal gasification to syngas to methanol blocks to new ways of doing chemicals to biofuels. You can name 15 different technologies, and even within these technologies, like if you take fuel cells, you could have solid oxide, you can have PEM can be HT-PEM, LT-PEM, batteries can be lithium-ion based, now there is sodium-ion based, grid scale. So there is just humongous change that is coming on the energy front. So what we have is what we have commercialized or close to commercialized for the defense is a phosphorus acid-based fuel cell, which is good for the sizes that we are talking about. It's also a very stable technology, which is what the industry needs, because it's defense. You cannot have The technology itself has to be very stable, and we've been testing it with the defense and with the Navy for quite some time. So in that sense, this particular product is close to commercialization, but this is not a product which will be used by mobility or will be used in other places. Yeah, there you will have to go to different technologies, and you would have seen previously we had talked about, and there was a press release also where we got an award for our HT-PEM technology. But I would say that whole area of fuel cells, I don't think we will have anything ready for commercialization in the next 12 to 24 months. Yeah, there is a lot of work that has to be done, not just by Thermax, by many people in the industry to hit some of the price points that are needed. And these are all ecosystem bets where you can't be working in unison, just like in the case of the defense application. We were working with L&T and with the Navy itself to manage. Similarly, we will have to work these as ecosystem bets. I would say it's a big area of focus for us. Cannot commit to what it will look like. Yeah, and as I said, it's not just one. There are like a dozen plus new things for Thermax to look at. Yeah, and many of these will be done through partnerships. One such area is on the solar front, where we think technology is changing very rapidly, both on PV side, but also on some of the thin film side. Yeah, on the thin film side, the challenge that you have is what you have as thin film solar today is actually expensive solar. Yeah, because the price point of some of these thin films and the efficiency that you get is not very good, which means the thin films are limited to a very small set of applications. We think technology exists and these are all new things. Yeah? So there is a technology risk with every one of these things, that you can come up with new spaces, because solar is something India will need in lot of different forms. Yeah, and just like once a technology starts to mature, it will have lot of different sub-segments start to open up. We think there are several very good sub-segments opening up in solar, where one of these segments, which is sufficiently large, is where we think the partnership that we have done, which will take us at least 1 year to just indigenize the technology itself. Yeah, and it will come with its own risk. So it's at least 18 months before we will have a commercial product ready for the market. And we will be doing a lot of work in the interim period, because we think the technology is very exciting, where we will be going through testing the technology. Then if the technology tests go well, then setting up a manufacturing plant. The manufacturing is also not trivial. So then that plant will take some amount of time to stabilize. So it's 18 months before we can say with confidence. But with every 6 months, we can come back and say, look, are we moving on the track that we thought we would be moving? So a long answer to your 3 questions.
Thank you. The next question is from the line of Renji.
Sorry, before you ask the question, how much more time do we have?
I think there are about 10, 12 questions, and I think we have time till 12:30, if I'm not wrong.
Okay, so 12:30, I think right before 12:30, we'll take our last question. We'll stop a little after 12 o'clock, 12:30, if that's okay.
Sure.
Thank you. The next question is from the line of Ranjit Sivaram from ICICI Securities. Please go ahead.
Yeah, hi, good morning and congrats on a good set of numbers. So if we look at the overall performance of the subsidiaries, because last time we were concerned regarding Danstoker. So how has the subsidiaries performance come up, and what's the outlook over there? Do you see things normalizing, because the impact of second wave is limited over there? So what's your outlook there, and what do you expect from this?
Look, I think one more good question. We've been very open that 2 of our international subsidiaries, specifically Danstoker and then our plant in Indonesia, both for different reasons, are continuing to be work in progress. Q4 was again not a great.
The line for the management is disconnected. Kindly stay on line till I reconnect them. Ladies and gentlemen, we have Mr. Ashish Bhandari reconnected to the call. Thank you and over to you, sir.
And thank you, everyone, and my apologies, the line just disconnected. So I'll continue. I don't know how much you heard, but I'll very quickly mention that in Q4, I don't think we saw anything that said that both of these businesses are back on track, and we can say that they're back on any sort of a growth trajectory. The fact that we've not been able to travel, not only that, in places like Indonesia where the factory leader had to go from India, the person took nearly 10 months from the time we made the decision for him to move and when he could actually get in Indonesia. And he landed in Indonesia, and Southeast Asia is going through its own second wave and limiting problems and all of that. So it's not that everything has been under our control. There are things that we want to put into action, but it has been quite challenged to execute those because we just haven't had the feet on the street either because of all the COVID challenges. So I would say Q4 was not as bad as maybe a couple of other quarters in the year, but I don't think we have confidence to say that we have entirely turned the corner. At least in Denmark, in March and in April, we started to see recovery in the order book, which I think is a good early sign, but it's too early to say if that is completely a trend that has now reversed. Too early to say. I think in Indonesia, we do expect demand will come back. Then the question is what our win rates will be. I think we are putting a lot of time and energy in building local sub-suppliers, bringing our cost of production down, becoming a truly local company, and focus is more on making sure that whatever we deliver is of the highest quality. So for the short term, our focus is more on making sure that customers become fans of Thermax, which means even if we are slightly delayed, even if our cost is higher, we want to be sure that our quality is really, really good because we are there for the long run. So I think my answer to you is both of these are still work in progress. Both of them are something that we know and we realize we have to improve. Some challenges, some signs of recovery as well, but too early to say if we have really turned the corner. Rajendran, would you have anything to add?
None beyond what you have said, Ashish. Thank you.
Sir, and next I will just like to know what is the contribution currently.
Sorry to interrupt, sir. I would request you to rejoin the queue for follow-up questions.
Okay.
Thank you. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, a very good afternoon. My first question is pertaining to the chemicals segment. A couple of years back, we had shared the breakup between specialty chemicals as well as resins was 50-50. Of course, you highlighted in the presentation that specialty is growing at a much faster pace of 62% last year. If you can share what is the current breakup and how do you see the mix evolving between these two subsegments of chemicals? And second question is pertaining to the enviro segment, where X of the FGD orders where we had in the order book, the run rate on a quarterly basis used to vary between 180 to 200 crores, which has got stepped up in the past 2 quarters. If you can highlight how much of FGD order revenue was booked in FY21, and has this run rate improved from that 180 to 200 crore band where we were operating? Thank you.
Okay. Two good questions again. On the chemical side, I'll give you again a slightly longer answer. And you asked a question on specialty chemicals. On our resin side, we have specialty and then not specialty on the resin side. And then we have a water chemicals business. And then we have construction chemicals. And then we have oil field chemicals. Yeah, so our 4 major lines of business, or 4 set of products that we have are resin, which has a portion of which is specialty. We have water chemicals, we have construction chemicals, and oil field chemicals. The 2 biggest portions of these business are water chemicals and the resins business, and of which the single most profitable portion is the specialty resins, but even water chemicals overall is reasonably profitable. Currently, our focus is on growing both of these, which is the water chemicals and on the overall resin business. Within the resin business, because we have added capacity, in the short term, we think that while the absolute volume of specialty chemicals will continue to hold steady and grow slightly, because first our focus has to fill up the plant, the overall resin number where the non-specialty resins grow faster will be seen in the short term. Over the long run, we continue to feel that specialty chemicals, if we do everything right, should grow faster. Yeah, not just that, if you can take a look at, even right now, what is going on in the pharma industry as an example. I do think India too will require more and more capability on the specialty chemical side, and some of which, if we are able to connect the dots well, are things that Thermax too can take an advantage on. So what I mean by the long run is more of 2 to 3 year period. We do think specialty chemicals over that period will continue to be the fastest growing portion within Thermax. But in the short term, I do think as we fill the additional capacity that we have, that overall resins will grow. We expect to grow faster, but we don't look. All of it will depend on, as we work with customers, as our capacity stabilizes, what kind of orders we get, etc., etc. Our focus right now is to grow all of these, because all of these are ultimately accretive to Thermax as a whole and are profitable. So that's the first question. Specific to FGD, I think when we have seen this broad-based recovery, it is true that our Enviro business has had better than an average run rate of business, because we have seen overall customers have looked at pollution control in a positive frame in this current period. And as I said, this has been across multiple segments, and this is a good example of broad-based recovery. We have had no projects at all from FGDs in India. Yeah, maybe 1 or 2 really small, like changeovers and etc. We had one international FGD order, which was less than 100 crores, but nothing from India. Yeah, so the big FGD projects, we are still waiting. But we had seen some of them getting closer and closer to finalization. And as we win or not win, we will come back and share. I think on the overall Enviro business outside of the FGD, whether that broad-based recovery will continue or not, look, I think I come back to that same initial point that I make, whether I don't know if after this second wave will the recovery be as good as it was after the first wave. Yeah, and I think I'll leave it up to all of you.
So, Ashish, sorry to interrupt. My FGD query was pertaining to what 2 orders we already have in the book. How much of that was booked in the
you to rejoin the queue, sir.
Okay. Okay, thanks.
Sorry, is the question on the
Backlog, whatever FGD was there, how much revenue has been booked on those two projects is what I want to know.
Okay. Rajendran, can you answer that question?
Yeah. So if you're looking to understand how much of revenue has been booked of the FGD businesses that we have booked in the past? Yeah. Okay. So we would have booked roughly about 100 crores in this financial year.
Possibly more than 1,000 crores or close to 1,000 crores that we have.
Yeah, about 900 plus crores was the order book on the two orders. So we booked about 100 this financial year. Yeah, thanks.
Thank you. The next question is from the line of Himanshu Upadhyay from PGIM Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon. See, I had a question on, in our last annual report, we have mentioned that we have 547 chillers online or brought online for remote online system. How has this figure improved and what is the penetration level within our own manufactured chillers and how large can be this figure? Also, are we connecting third-party manufactured chillers and providing AMC type of service or not? Some idea and what progress have we achieved in last 1 year?
Okay. So I don't know the number exactly what the total stands, but I do know this year we have added more than 100 new chillers onto what we call as part of our remote monitoring. And the penetration overall of our install base, of our operating install base, for this remote monitoring capability would be more than 80%. And through this past year, there's been some really good stories where our international customers, because our chillers and our absorption cooling business is one of the most international businesses that we have within Thermax, where our install base outside India is actually more than what our install base in India is. And many of those customers we were able to support only because of this remote monitoring capability. Yes, so it's been something that has been helpful. We continue to grow it. Remote monitoring, doing more with data across, and I think I go back to that whole services and products business and discussion that we had without giving any numbers. Overall, is something that we can do better on. Yeah, how Thermax manages data. I think to your question on third party or not, within chillers, we have no third party. Equipment being monitored. In the rest of the business, is that something that we have the capability to? Of course, we have the capability to. Is that something that we are doing a lot of? Not today. Is that something that we would like to do in the future? Yeah.
Okay, and one question on chemicals business. There are many small companies in the chemical domain. And we had written in last annual report about M&A opportunities in chemicals business.
Sorry to interrupt, Mr. Upadhyay. So there is a disturbance coming from your line while you're speaking.
Yeah, so I'll repeat it. In chemicals, there are many small companies in the chemical domain, and we had written in our annual report that we'll be looking for M&A opportunities. The purpose of M&A would be to add new products or get more customers in various industries and geographies for us. If you can just throw some light on this. And how is the thing happened in last 1 year on this side?
So I think in overall, we would like to do, and you can see we've been a lot more active. And by, I said, business development opportunities, where we are very open to partnerships, doing alliances, doing in some cases around technology, M&A as well. But in all of those cases on technology, we would like to see clear enhancements to our existing portfolio set. Yeah, and that we haven't really seen any very good candidates. Yeah, the multiples for what many of the chemicals companies in India have expected are extremely high, and we are frugal in that sense. And internationally, we had very narrow two specific areas where we are looking for M&A activity. I would not want to share what those two areas are. They both relate to increasing our market access in a couple of very, very specific geographies. And as those become available, it all depends. Yeah, we're going to be choosy. We won't be indiscriminate. As any of those become available, we would be more than happy to come and share that progress with. But don't expect like a really big M&A or something that will even add 10-20% to our chemicals business. These will be relatively small if they happen, and something that we can then add incremental and continuous capability.
Okay, thank you from my side. Yeah.
Thank you. The next question is from the line of Jeetu Punjabi from EM Capital Advisors. Please go ahead.
Thanks, Ashish, for a great explanation. I've got two very big picture questions. It seems like, at least for the whole capex-driven businesses, this is the first time after many, many years of a long drought, there's tailwind coming in. So what's happened so far has been a function of talent and hard work, but there's no real tailwind that's come in. The question is, one, do you really expect this to play out? And I'm not looking at the next 3 or 6 months. I'm talking about 2 to 3 years. Do you really expect this to play out? Second, how do you think it would be different if it plays out the way a true capex cycle would play out? And three, do you think the competitive advantage you have or the weaknesses you have are going to have a role as this plays out? In the sense, do you think you'll have a fair chance to win relative to competitors, and that could give you some really fantastic numbers and profits?
A leading question, I would say, but I'll divide my answer on the first part. I think it would not be proper for me to say, and what we have seen in this last 1 year, that even the best of analysts, whatever projections, etc., many of them have come to not be true. Yeah, like first the doomsday projections, then kind of how quick the recovery will be once the recovery happens, how good the recovery will be, then the second wave, all of that. Yeah, so I think I said that previously in my discussion as well, that we are thankful for the kind of recovery it was. We will not be looking too far ahead in terms of is this cycle going to be 3 years, 5 years, whatever. I think I've been very clear that our focus is on making sure that the things that we can control, which are on the products and services, on some of these new energy elements, all of these capabilities, and making us very resilient in continuing to invest and getting better and better at those areas. Because to the question that was answered previously, that in that 5 to 10 year period, we do think the nature of energy will change quite dramatically world over and even in India. Yeah, so our focus is in making sure that we are ready to win and at least retire some of the risks that we have in the business for that particular period. So I think that's how I would answer. Our competitive strengths and weaknesses, I think, look, our competitors are very, very good as well. Yeah, so it's not like we have some dramatic capability that none of our competitors have, or a cost basis which is particularly differentiated by any means. What we do have, I think, is that when the application becomes more challenging, Thermax's ability to deliver that application in a better way and in a way that customers trust more. Yeah, which means when something like waste heat recovery, which is a relatively decent application to talk about, but it's not cut and dry. Yeah, it is something that you retrofit. It is something that you have to go, and the guarantee itself is not exactly can be proven out because it is dependent on waste heat recovery itself, and it's dependent on it's a byproduct process effectively. In a lot of these kinds of things where customers saying, okay, I'm running coal, but tomorrow can I mix it with coal, the gas, or can I do spent wash? In many of these cases, we do think customers trust Thermax more. Yeah, because of our ability to not let go, and our ability to continue to be with the customer for a very long period of time, I also think when customers look at services, customers look at build, own, operate models, they will trust Thermax more. We also have the capability to bring financing into play in a much bigger way than some of our competitors. Yeah, we have a strong treasury. We have got lot of weapons to come to bear in some of those differentiating offerings. And we do think there the market is changing somewhat, and customers are a lot more amenable to doing utility as a service going forward, because some of these are also green. They also require different technologies. I think we don't talk about it much, but we are one of the largest biomass solution providers in India. And in part of our build, own, operate, almost, a majority of our portfolio is based on biomass. Yeah, and so we touch biomass, which all across India in a way that few other companies in India do. So all of that is credit to the execution capability of Thermax. I don't know if that is by itself going to give us great upside. I think it gives us confidence, but it means we have got lot more of other things to do to be able to continue to do it. Last question, guys.
Thank you. So can we take one last question now? Or?
One last question, yes, please.
Okay, sir. Thank you. The last question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Sorry. I think the question left in between what I asked you. So you gave a fair amount of, the opportunity in the waste heat recovery part in cement. So the idea was that because the kind of value you're getting from a captive power plant going to waste heat recovery, your value goes down. But I understood the point what you're trying to make is that overall opportunity goes up. But, the question was more from because when we look at the 5 top players in cement, which is 70% of the capacity, they already reached a 50% WHRS. So, but I got your point. The question now is, sir, when you talked about, you clearly articulated your new ventures here. And on a macro side, you articulated that. If one has to boil down towards the R&D of that, I'm not talking about the JV what you have done in the waste to part in the waste energy part. I'm talking about more of hydrogen and fuel cells. When we look at globally companies who are now commercializing the product, if I just add up their R&Ds in the last 4-5 years, they spend almost what is the PAT of our company on an annualized basis. Can you throw some light how we will do the R&D part? What sort of strength in R&D we will eventually put? What's the spend we are looking to do it in the next 2-3 years to actually let this commercialization happen? Because the end market, how will it react? Nobody knows it. But just at your end, if you can throw some light on that. Thank you very much.
I think, and it's a good last question as well, because it brings forward some of the most important decisions in some ways in front of Thermax. In all of these cases, whether to build our own, whether to take somebody's technology entirely and become the Indian manufacturer of that, become something in between where you take a technology license and you are able to build on that. All of these are decisions in front of Thermax. And right now, I would say we have a critical team looking at all of these options. I would say our investment from a rupee portion is definitely much lesser than any of the global guys. Yeah, completely. Clearly agreed. And in many cases, there are startups which have $50-100 million of funding going for just one of these application spaces. But I would counter that by these 2 things. First, in our case, in at least the fuel cells, these have been work in progress for 9 years for us. Yeah, and in all of these cases, we have been working not just with Thermax's own capabilities, but also We have had funding, etc., available from the government, and we've been working with some of the best Indian institutions in terms of getting our technology this far. Yeah, which means our understanding and to be able to provide an end product in that sense, which is being tested for a really tough application like the Navy has put forward. It shows at least some capability that we can put the entire solution together. We understand all the building blocks very well. We understand some of the technology challenges. That said, I've been very clear that if we do everything on our own, I think we are far away from commercializing a product in the near future. So we have some very difficult decisions in front of us, some very good decisions also, because it's not like anybody else in India has figured that out. Yeah, and for India as a country, to figure this out will be very important. So I don't know what the future looks like. I think over the next year, I hope I can give you some more clarity, and you will see these as moves that we make in the industry as well. All options are on the table. There is no sacred cow out here. And I don't know what the future looks like, honestly.
Thank you very much, sir. Thank you.
Thank you. I would now like to hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors for closing comments.
Yes, sir. Thank you very much for giving us an opportunity to host the call and giving your insights on how we are looking at Thermax. Wishing you and your entire team all the very best. Thank you, everybody, for being on the call.
Thank you very much, everyone. I hope you continue to stay safe, and wishing you a very good rest of the day. Thank you so much for spending the time with us today.
Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.